Owning rental property is one of the best wealth building strategies in America. And the tax code is surprisingly generous to landlords if you know how to use it. Depreciation, expense deductions, passive loss rules, all of these can dramatically reduce or even eliminate your tax liability on rental income. But only if you do it right. Let's break it all down. Welcome to taxmerica.co. I'm Sharon, and today's video is for landlords, Airbnb hosts, and real estate investors of all kinds. We're covering how rental income is taxed, every expense you can deduct, the powerful depreciation deduction explained simply, passive activity rules, and the $25,000 rental loss allowance, Schedule E walkthrough, and special rules for short-term rentals like Airbnb. This is a comprehensive guide. Bookmark it and come back as you need it. Ordinary income treatment. Rental income is generally taxed as ordinary income at your regular marginal tax rate. It's reported on Schedule E, which attaches to your Form 1040. The good news, you can offset rental income with rental expenses and depreciation, often dramatically reducing the taxable amount. In many cases, landlords with significant depreciation show a paper loss on Schedule E even while the property generates positive cash flow. The 14-day rule for personal use. If you rent your property and also use it personally, there are important rules. If you rent it out for 14 days or fewer per year, the rental income is completely tax-free. No reporting required. This is the famous master's exception used by homeowners near the Augusta National Golf Course who rent for the tournament. If you rent it for more than 14 days and use it personally for more than the greater of 14 days or 10% of rental days, it becomes a mixed-use property with more complex rules. If it's purely a rental, no personal use, you get the full benefit of all the deductions. Airbnb hosts. Track your personal use days meticulously. Even one extra day over the threshold changes your tax treatment significantly. Self-employment tax. Does it apply? Here's the good news for most landlords. Rental income is generally not subject to self-employment tax. Unlike freelance income, where you pay 15.3% SC tax, rental income sits outside that. However, if you provide substantial services to tenants, like a bed and breakfast or hotel-style operation, the IRS may classify you as actively engaged in a business, subjecting that income to SC tax. The line between rental income and service income matters. The golden rule. Every ordinary and necessary expense related to your rental property is deductible. Let's go through each category. This is where landlords save the most money. Deductible expenses. Mortgage interest. The interest portion of your rental property mortgage payment is fully deductible. Note, the principal portion is not deductible. That's equity building, not an expense. Your lender will send you Form 1098 showing interest paid. Property taxes. Real estate property taxes paid on your rental property are fully deductible as a rental expense. No $10,000 SALT cap applies to rental property taxes. The cap only applies to personal resident taxes claimed on Schedule E. Insurance. Landlord insurance premiums, liability coverage, and property insurance are fully deductible. Repairs and improvements. Repairs versus improvements, critical distinction. Repairs are immediately deductible. Improvements must be depreciated over time. Repairs maintain the property in its current condition. Fixing a leaky faucet, repainting, patching, drywall. Improvements add value or extend the property's useful life. New roof, adding a room, replacing the HVAC system. Getting this distinction right is important. The IRS scrutinizes it. Property management fees. If you use a property manager, their fees, typically 8 to 12% of monthly rent, are fully deductible. Professional services. Attorney fees for lease drafting, accounting and tax preparation fees, and any other professional services related to the rental are deductible. Advertising. Listing fees on Zillow, Airbnb, VRBO, or any advertising costs to attract tenants are deductible. Utilities paid by landlord. If you pay water, trash, gas, or electricity for your rental, those are deductible. Travel. Mileage driven to the rental property for inspections, repairs, or management is deductible at 67 cents per mile in 2024. For long distance travel, actual expenses may apply. Keep a log. Depreciation, your most powerful deduction. Depreciation is the crown jewel of rental property taxation. The IRS recognizes that buildings wear out over time, so it lets you deduct a portion of the property's value each year. Even though you're not spending any money for residential rental property, you depreciate the building, not the land, over 27.5 years using straight line depreciation. Example, you purchased a rental home for $300,000. The land is worth $50,000. Your depreciable basis is $250,000 annual depreciation. $250,000 divided by 27.5, that's a $9,090 deduction every year. In cash flow terms, completely non-cash. You might collect $20,000 in rent but show much less taxable income after depreciation. Cost segregation study. For larger properties, a cost segregation study reclassifies components of the building, carpeting, appliances, land improvements, into shorter depreciation schedules of 5, 7, or 15 years. Combined with bonus depreciation, this can generate massive first-year deductions. This strategy is typically used for properties worth $500,000 or more. Here is a pro tip. Depreciation does come with a catch. When you sell the property, the IRS taxes with the depreciation you claimed at a special recapture rate of up to 25%. This is called unrecaptured section 1250K. Plan your exit strategy with a tax advisor to manage this. What are passive active rules? The IRS generally classifies rental activity as passive. Passive losses can only offset passive income, not your W-2 wages or business income. So if your rental property shows a $15,000 loss on Schedule E, you generally cannot deduct that against your salary. The loss is suspended and carried forward to future years, where it can offset future rental income or gains when you sell. The $25,000 special allowance. There is a key exception for active participants in rental real estate. If you actively participate in managing your rental, making management decisions like approving tenants, setting rents, or authorizing repairs, and your modified adjusted gross income (MAGI) is under $100,000, you can deduct up to $25,000 in rental losses against ordinary income. This allowance phases out between $100,000 and $150,000 MAGI, disappearing entirely above $150,000. Active participation is a lower standard than material participation. You don't need to manage the property personally. You just need to make the major decisions. Even using a property manager qualifies, as long as you're making the big calls. Real estate professional status, the big unlock. If you or your spouse qualifies as a real estate professional for tax purposes, the passive activity rules don't apply to your rental activities. Your rental losses can offset all types of income, W-2 wages, business income, everything. To qualify, you must spend more than 750 hours per year in real property trades or businesses in which you materially participate, and those hours must exceed the time you spend in any other profession. This is a genuine standard, not a loophole anyone can claim. But for full-time real estate investors or real estate agents who also own rentals, this is a powerful classification worth pursuing. A married couple where one spouse qualifies as a real estate professional and the other has a high W-2 income can potentially use unlimited rental losses to offset that W-2 income, generating massive tax savings. This is one of the most powerful strategies in real estate tax planning. Short-term rental unique rules. Short-term rental platforms like Airbnb, VRBO, and HipCam have exploded in popularity. The tax rules are different from traditional long-term rentals. If the average rental period is 7 days or fewer, the activity is not automatically passive. It's treated more like a business. This means you could potentially be subjected to self-employment tax on net income. But you can also offset losses against active income more readily if you materially participate in managing the rental. Airbnb specific deductions. Platform fees. Airbnb takes a host service fee, fully deductible. Supplies, towels, toiletries, coffee, cleaning supplies for guests, deductible. Cleaning services. Fees paid for professional cleaning between guests, fully deductible. Furnishings. Furniture, appliances and decor for the rental, deductible or depreciable depending on cost. Photography. Professional photos for your listing, deductible marketing expense. Utilities. Allocate based on rental versus personal use days. Local taxes and licenses. Many cities and states now require short-term rental hosts to collect and remit occupancy taxes, similar to hotel taxes. Airbnb collects these automatically in some jurisdictions but not all. Make sure you understand your local obligations. Failure to collect and remit occupancy taxes can result in back taxes, penalties, and in some cities, license revocation. Also, check local zoning laws. Some municipalities have restricted or banned short-term rentals entirely. Here is a pro tip. Taxmerico.co works with Airbnb hosts across the US to optimize deductions, handle multi-state tax obligations, and ensure full compliance. Visit taxmerico.co to schedule a rental property tax review. Key takeaways. Rental income is taxed as ordinary income, but deductions and depreciation can dramatically reduce your taxable amount. Track every expense: mortgage interest, taxes, insurance, repairs, management fees, and mileage. Depreciation is non-cash but generates a real deduction and must be tracked carefully for eventual sale. Passive loss rules limit how much rental loss offsets other income unless you qualify for the $25,000 allowance or real estate professional status. Short-term rentals have different rules. Know which category your activity falls into. Always plan your rental property exit strategy with a tax professional. Depreciation recapture can be significant. Rental real estate can be one of the most tax-efficient wealth-building tools available to Americans when you use the tax code strategically. At taxmerico.co, we specialize in real estate tax strategy for landlords and investors at every level. Visit taxmerico.co to connect with our team and take control of your rental property taxes. Like and subscribe, and see you next week. If this video helped you, like it and subscribe for weekly tax tips. Drop your questions in the comments and we read everyone. Book a free 15-minute tax consultation at taxmerico.co and we'll let our experts handle your taxes stress-free this season. Thank you.